Welcome to The Explainer. Today, we are diving into what I can only call a true financial detective story. We're looking at a company called Nextpower, trading under the ticker symbol NXT. Now, if you've been keeping an eye on the markets recently, you know that this stock has been putting on an absolute clinic in market performance. But in finance, a soaring stock chart is really just the cover of the book. We want to read the actual pages. So today, we're going to look under the hood, dig into the raw data, and uncover exactly what is powering Nextpower's incredible recent run.
Just look at this number on your screen, 183.75%. That is Nextpower's trailing 12-month, or TTM, stock return. Literally, in just a single year, an investment in this company has almost tripled. To put that into perspective for a second, a really great year for a broad market index is usually around 10 to 12%. Nextpower has absolutely shattered that, leaving a lot of investors scrambling to understand how this happened so incredibly fast. And that brings us to the central mystery of our explainer today. What on earth drives this kind of parabolic growth? I mean, is this just pure market hype? A speculative bubble inflating on the back of retail momentum? Or is there a massive fundamental engine of cash and profit powering this ascent? To figure this out, we can't just stare at the stock chart. We have to interrogate the business itself.
Okay, let's dive into this. Here's our roadmap for today. First, we'll look at the stock price phenomenon. Second, revenue and profit growth. Third, financial health and efficiency. And finally, we'll do a valuation reality check. All right, starting right off with Section 1, the stock price phenomenon. Let's analyze this 183% surge.
When we look at Nextpower's recent timeline, you get this drastic, almost whiplash-inducing turnaround. Back in 2024, honestly, things were looking quite bleak, with the stock posting a negative return of over 22%. But then, the script completely flipped. 2025 delivered an absolutely explosive 138% return. And get this, the momentum hasn't even stopped. As we look at 2026 year-to-date, the stock is already up another 40%. We're not talking about slow, steady growth here. This is sudden and violent acceleration.
The sheer velocity of this upward swing is just staggering. Think about it. If you had perfectly timed the bottom back in April of 2025, you could have bought shares for just $37.16. Fast forward to the 52-week high in March of 2026, and those exact same shares were trading at $131.72. That is a massive 229% swing from the absolute bottom to the top. The volatility here is off the charts, and it practically demands an explanation from the underlying business metrics.
Which leads us right into Section 2, revenue and profit growth. Let's look under the hood. This data brilliantly illustrates exactly what investors are cheering for right now. If we compare the 3-year compound annual growth rate, the revenue is highly impressive on its own. It's growing at roughly 25.5% a year. But look at that profit bar. It completely towers over the revenue. Net income has compounded at over 81% annually for the last 3 years. This shows us incredible operating leverage. Basically, as Nextpower scales up and brings in more revenue, a disproportionately massive amount of that money is falling straight to the bottom line as pure profit.
But, in finance, there's an old saying, profits are an opinion, but cash is a fact. You can use accounting tricks all day to make net income look good, but free cash flow, that doesn't lie. And Nextpower's free cash flow has absolutely skyrocketed, compounding at almost 177% annually over the last 3 years, hitting $587 million in the trailing 12 months. This proves that the profits we just saw are real, hard cash, not just accounting illusions. The fundamental engine here is completely roaring.
Moving on to Section 3, Financial Health and Efficiency. Let's check out these peak operations.
To measure this, we're going to look at my absolute favorite metric, ROIC, or return on invested capital. Simply put, this tells us the percentage return a company makes on the cash it reinvests back into its own business. Think of it like a company's internal interest rate. Right now, Nextpower's ROIC sits at a phenomenal 29.59%. Let me act as a translator here for a second. What this actually means is that for every single dollar Nextpower invests back into its operations, it generates nearly 30 cents in return. That is elite-level capital allocation.
And let's see how this efficiency builds right across the board, because it's definitely not isolated just to ROIC. Their return on equity is an outstanding 27.53%. Their net profit margin is a very healthy 17.68%. What the data shows us is that all of these numbers are currently beating their historical 3-year averages. This tells us a super clear story. Nextpower is a company running at absolute peak operational efficiency right now.
But brace yourselves, because here is the most shocking number in our entire dataset: 0. Yep, 0. This is Nextpower's debt-to-equity ratio. In the modern corporate world, finding a company growing its revenue at 25% and its cash flow at 170%, all while carrying literally 0 debt, it's like finding a unicorn. They're funding all of this explosive growth entirely organically, without borrowing a dime. This means the risk of bankruptcy from overleverage is virtually non-existent.
All right, that brings us to our final step, Section 4, the valuation reality check. Let's price the premium.
So the crucial point is neutrally contrasting the market's sky-high enthusiasm with the mathematically calculated fair value, basically checking the actual sticker price at the dealership. The stock recently closed at $122.58. However, based on discounted cash flow models, which, as a reminder, forecast the company's future cash and discount it back to today, the calculated fair value price is only $97.72.
Because the market price is so much higher than that fair value price, the margin of safety is strictly negative, sitting at minus 25.44%. So why does this matter to you? Well, it means that if you buy the stock right now, you are not getting a discount. In fact, you're paying roughly a 25% premium over its intrinsic value. You're essentially paying up significantly for all that future growth today.
And we can see this premium priced into almost every multiple. Let's look at the PE, or price-to-earnings ratio. It's currently at 31.35, which is notably higher than its trailing 12-month average of 23.33. The exact same thing goes for the price-to-sales ratio. It's currently over 5, compared to a historical average closer to 3. And the price-to-book ratio has stretched all the way to 8.46. Across the board, current valuation multiples are trading significantly higher than their historical averages. The market knows this is a great company, and it's charging top dollar for a ticket to the show.
Which leaves us with the ultimate question. Is this a great company, or is it just too expensive? Throughout our explainer today, the data has revealed an undeniable tension. On one hand, you have nearly perfect fundamental health, 0 debt, massive cash flow growth, and elite operational efficiency. But on the other hand, you have a steep premium price tag with a negative margin of safety. Does the pristine quality of this business truly justify paying a 25% premium today? Well, that is the question you'll have to weigh for yourself.